What is P2P lending? Since 2005, almost unnoticed by public attention, a new asset class has emerged that was previously only available to banks. Thanks to innovative fintech startups, this asset class is now also available to us private investors. The catchphrase is investing in P2P loans, or P2P lending. Since around 2005, hundreds of P2P marketplaces have emerged worldwide, with total sales of $3.2 billion in 2015, and some of them offering extremely attractive interest rates. For this reason, we will have a look at what P2P lending is, how it differs from conventional banking, and what opportunities and risks it offers. To understand how P2P lending differs from the classic lending business, let's first take a look at the classic bank business. The core business of private bank houses and savings banks is, on the one hand, to manage customer deposits and, on the other hand, to lend them to other customers in the form of loans. Deposits are customers who make a bank deposit. This could be a loan on the current account, call money account, savings book, or an investment is a fixed-term deposit. The bank works with this money and its equity. The bank pays interest to the depositors and the bank charges interest from the borrowers. The difference between the two interest rates is the bank's net interest income with which it earns its money. The loans that the bank issues are therefore financed with customer deposits and the bank's equity. There is no direct link between the depositors and the borrowers, as the bank bears the entire risk of the loans. In return, however, it does not involve the depositors in the loan interest. P2P, or peer-to-peer, is initially not a credit-related term, but is always used when something happens from person to person, for example a transaction between two private individuals. The counterpart to P2P is B2B or B2C, business to business, between companies, or business to customer, from company to customer or a private person. This explains very well what a P2P loan is. It is a loan from one private person to another. So P2P lending is basically nothing new. In the past, it was also possible to grant a private person a private loan. However, with the establishment of Zopa, the first P2P marketplace, which emerged in the UK in 2005, this process was taken to the next level and credit trading was also made available to private individuals. On P2P marketplaces, loan seekers can submit loan inquiries that are accessible to private, and now also institutional, investors who can then invest in these loans. The investors receive the interest payments on the loans directly. The marketplaces earn a one-time fee, both on the credit side and on the investor side, and therefore do not participate in the interest payments. Two very interesting and trustworthy platforms are Bondora and Mintos. Find links below the video. Nowadays, P2P marketplaces offer their investors an assessment of the creditworthiness of the borrower and thus a risk assessment in the event that the credit fails completely or partially. Thanks to P2P lending, it is now also possible for private individuals to invest in numerous loans. Investors can secure attractive interest rates, and borrowers now have the option of obtaining a loan even if they were previously unable to get it from banks. Both borrowers and investors benefit from very fast and efficiently functioning P2P marketplaces. In contrast to banks, it is not the task of the P2P platform to grant or decline loans. They serve solely as a marketplace to match the demand for money from borrowers with the money supply from investors. Your main task is to assess the creditworthiness, for example the long-term solvency of the borrower. To this end, most platforms classify the loans in risk classes. For example, from A to E, the interest rate that the borrower pays depends on the credit rating class in which he is located. But be careful, P2P loans can be risky. In contrast to banks, P2P lending providers do not have any deposit insurance. Have in mind that loans cannot be repaid by borrowers and the money invested is thus lost. Even the buyback guarantees of some providers cannot provide complete protection, as the guarantor can also go bankrupt. High return equals high risk. If you decide to invest in P2P loans, we recommend that you only invest a small part, max 5%, of your assets in such a risky asset class. Nonetheless, P2P lending is an interesting investment alternative that offers an alternative investment possibility. The new asset class for private investors is an interesting and unbureaucratic alternative to traditional bank loans for borrowers. So please keep in mind, investing in high return opportunities involves high risks, which you should always be aware of.